Hey everyone, welcome back to Corporate Decoder. Get ready for a deep dive into Solo Brands' latest financial report, where things are, let's just say, going through a major reset. Today we're breaking down the Q2 2025 report for Solo Brands, the company behind Solo Stove and Chubbies. They've gone through some big financial shifts and we're here to decode exactly what those numbers mean for the business and for you. Let's start with a crucial piece of context. As of August 2025, over 1.5 million shares of their Class A stock were out there. But here's the kicker. They recently did a massive 1-for-40 reverse stock split. Think of it like taking 40 individual chips and turning them into just one much more valuable chip. This was a big move, partly to get their stock price back up so they didn't get kicked off the New York Stock Exchange. It definitely changes how we look at share counts and per share earnings. Now for the nitty gritty. Looking at their balance sheet, which shows what they own and what they owe, things have changed quite a bit from the end of 2024. Their accounts payable, which is what they owe to suppliers, dropped dramatically from nearly $70 million at the end of last year down to just under $10 million. That's a huge reduction. It suggests they've either paid off a lot of their bills or perhaps restructured how they pay their suppliers. On the flip side, their cash and cash equivalents actually increased a bit from around $12 million to over $18 million. This is interesting given the big drop in payables. It might mean they're holding on to cash more tightly, or perhaps the refinancing we'll talk about later brought in more funds. But here's the big story on the balance sheet. Their long-term debt, it shot up from about $42 million to over $237 million. This is a massive increase driven by the refinancing that happened in June 2025. They essentially took on a lot more debt, but it came with extended maturities and some flexibility on interest payments, which they say helped them navigate their tough financial situation. Now let's look at how they actually performed operationally. This is where we see the impact of their business decisions. Net sales took a significant hit. For the 3 months ending June 30, 2025, sales were just over $92 million in the same period last year. That's a nearly 30% drop. For the first 6 months, sales were around $160 million. This decline is a major red flag and shows their core business is struggling. Cost of goods sold also went down as you'd expect when sales fall, but here's an important point. Their gross profit margin actually squeezed a bit from 62.8% to 61.3% for the quarter. This isn't a huge drop, but it means that as sales shrank, their costs didn't shrink quite as fast, leading to less profit for every dollar sold. And then we have this monster of a line item: restructuring, contract termination, and impairment charges. In this quarter alone, it was over $10 million. For the first half of the year, it was over $16 million. Last year, zero. This shows a major push to cut costs and rethink their operations, but it comes at a significant price right now. They had to close 2 distribution centers, terminate agreements, and deal with severance packages for layoffs. All of this resulted in a substantial net loss. For the quarter, they lost over $20 million, and for the 6 months, the loss was nearly $40 million. This is a tough financial picture, and it underlines the challenges they're facing. Looking at their operating expenses, their selling, general, and administrative costs dropped significantly by about $23 million for the quarter. This is largely due to less spending on marketing and advertising, which makes sense if they're cutting back on sales efforts to focus on profitability and operational improvements. Now, let's drill down into those segment results, because that's where the real story unfolds. The Solo Stove segment, their flagship brand, saw a massive drop in sales. For the quarter, net sales plunged by almost 46%. Both their direct-to-consumer sales and retail sales took a big hit. They attribute this to focusing on price integrity this year instead of heavy promotions, and also cutting back on marketing spend. Basically, they sold less because they spent less to sell it and potentially asked customers to pay more. Chubbies, on the other hand, showed some resilience. Sales for the quarter actually grew by over 13%, driven by a nice jump in retail sales and a smaller increase in their direct-to-consumer business. This is a positive sign, suggesting at least one of their brands is finding better footing. When you look at segment EBITDA, which is a measure of profitability before certain expenses, Chubbies is really outshining Solo Stove. For the quarter, Chubbies generated over $11 million in EBITDA, while Solo Stove was barely positive at around $3 million. This highlights the stark contrast in performance between their two main brands. Let's talk about their cash situation and how they're managing it. Remember that big net loss we saw earlier? Well, the cash flow statement shows that the company used nearly $65 million in cash from operating activities for the first 6 months of 2025. This is a huge outflow and a key indicator of their financial strain. It's largely due to those working capital changes we touched on and the overall decline in their business operations, which impacts their net income. But here's the dramatic shift. Financing activities provided over $76 million in cash. This was mainly due to the refinancing we mentioned, where they brought in a lot of new debt. They borrowed over $207 million and repaid around $79 million. It's clear they are heavily relying on debt to keep the lights on and fund their restructuring efforts. Now, this is a critical section. For a while, there were serious doubts about whether Solo Brands could continue to operate as a going concern, meaning if they could stay in business. This was due to their consistent losses and cash flow problems. However, after the due refinancing, they believe they've alleviated these concerns. But here's a subtle but important risk factor. Their ability to maintain compliance with MOSEF listing standards. They had their stock suspended and then did that reverse split to avoid being delisted. While they say they've met the requirements for now, there's no guarantee it'll last. That 1-for-40 split might have boosted the share price temporarily, but the underlying business challenges remain and the market can be unforgiving. And then there's this material weakness in their internal controls over financial reporting. They've identified issues with how they handle financial information, including problems with separating duties, managing IT changes, and having enough staff in their accounting department. They're working on fixing this, but it suggests there might be some shaky ground when it comes to reliably reporting their financial health. The report is signed by the CEO and CFO, indicating these are the top leaders on record, acknowledging these financial statements and the events described. So what's my take on Solo Brands? It's a company in crisis, no doubt about it. The dramatic drop in sales for their core Solo Stove brand, coupled with massive debt increases and restructuring charges, paints a very challenging picture. Chubbies is showing some positive momentum, which is a bright spot, but it's not enough to offset the weakness elsewhere. They've clearly made big moves to stay afloat, like that significant refinancing and the reverse stock split to keep them on the NC. But the underlying business is clearly struggling, and those restructuring costs are substantial. The material weakness in financial reporting is also a concern, suggesting a need for stronger financial discipline spot, but it's not enough to offset the weakness elsewhere. They've clearly made big moves to stay afloat, like that significant refinancing and the reverse stock split to keep them on the end shares. But the underlying business is clearly struggling, and though success of these strategies, particularly around cost savings and improving the Solo Stove brand's performance, will be critical in the coming months, but the underlying business is clearly struggling, and though success of these strategies, particularly around cost savings. And what's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to join our Discord community linked in the description below for more behind the scenes discussions. Thanks for watching. See you next time.